What if I told you there is a stock right now, a real listed artificial intelligence company, where every single Wall Street analyst who covers it has slapped a buy rating on it? Not 5 out of 7, not 6, every single one. A perfect, unanimous consensus from the professional class. And yet, and this is the part that keeps me up at night, the stock has been quietly bleeding lower and lower. Think about how rare that is. You have credentialed professionals at major institutions, people whose entire job is to get this right, all pointing in the same direction, and the market is doing the exact opposite. That kind of disconnect does not happen often, and when it does, it almost never stays open for long. Welcome back to Smart Stock Sam, the channel where we dig past the headlines, past the noise, and into the actual data so you can make smarter, more confident decisions with your money. If you are new here, hit that subscribe button right now because today's deep dive is exactly the kind of analysis we live for on this channel. Today, we are putting a full spotlight on Rezolve AI, trading under the ticker RZLV. And before we even get into the numbers, let me give you the 30-second outline of what we are covering today, because this story has layers. We are going to walk through a jaw-dropping revenue acceleration that almost nobody is talking about. We are going to look at brand new partnership deals signed just days ago. We are going to follow the institutional money trail, and what BlackRock and UBS are quietly doing will surprise you. We will break down the technical chart setup and lay out a specific trade architecture for the current window. And yes, we will be completely honest about the risks, because on this channel, we never pretend a story is cleaner than it is. Stay with me all the way through, because the final piece, the valuation gap, is where this whole thing comes together. Let us start with the thing that should be making financial headlines, but somehow is not. We have a company here that generated $46.8 million in audited revenue for the entire 12 months of 2025. That is a solid, respectable number for a growing technology firm. Now here is where your jaw should drop. In just the first 90 days of 2026, a single quarter, Rezolve AI brought in $60 million. $60 million in 90 days versus $46.8 million for an entire prior year. They did not just beat their previous annual performance, they lapped it in one quarter. That puts them on a verified 248% year-over-year growth trajectory. And it makes their full-year guidance of $360 million look not just achievable, it actually starts to look conservative if they maintain anywhere near this pace. Now, the question every smart investor asks at this point is, where is this growth actually coming from? Because 248% does not happen by accident. It does not happen because someone ran a good marketing campaign. It happens because something structural changed inside the business. And for Rezolve AI, the answer comes down to two massive growth engines that are now firing simultaneously. The first engine is their partnership with the Enhanced Games, announced just this month on May 18th. This is a multi-million-dollar deal to build a mobile-first digital fan ecosystem for the Enhanced Games in Las Vegas. But there is a piece of this deal that almost nobody is talking about: the AI Doctor telehealth roadmap embedded inside the agreement. Think about what that means. They are not just building a fan app. They are building an integrated health and commerce AI platform around a global sporting event. That is a completely different category of revenue potential. But the second engine is the one that makes institutional investors sit up straight. Rezolve has formed an alliance with Tata Consultancy Services, TCS. If you are not already familiar, TCS is not a small player. They are a global titan in enterprise IT services, operating across 150 countries with a client roster that reads like a who's who of the Fortune 500. What Rezolve has done is integrate their core BrainPower platform directly into TCS's existing retail enterprise client base. What does that mean in plain English? It means Rezolve now has a built-in, ready-made global distribution channel, one that most startups would spend a decade and hundreds of millions of dollars trying to build from scratch. They essentially bought a highway to scale by becoming TCS's AI commerce layer. But here is the question you should always ask when a company starts announcing big partnerships. Does the technology actually hold up? Because in the enterprise world, deals fall apart all the time when the product does not deliver under pressure. So, let us look at the tech itself. There is a quiet but serious problem in global retail AI right now. It is called the 26% distortion crisis. Traditional AI models hallucinate. They produce inaccurate outputs about 26% of the time. In consumer commerce, that is not a minor bug. You cannot have an AI assistant giving a customer the wrong price, the wrong product specification, or completing a transaction with incorrect data. One bad interaction and you lose a customer for life. It is a deal breaker. Full stop. Rezolve's answer to this problem is their traceware technology. And this is not marketing language. This was peer-reviewed and validated for the ACMUMAP 2026 conference, one of the most respected academic venues in personalization and user modeling research. The validated accuracy range? Between 99.5 and 100% user state accuracy. Essentially, it eliminates AI hallucinations in live commercial transactions. That is not an incremental improvement over the competition. That is a category-defining advantage, and it is the reason TCS signed. It is the reason Enhanced Games signed. You do not partner with someone who has shaky tech when your brand is on the line. Now, I always say, do not just listen to what a company says about itself. Watch what the people with the most information, the insiders, are doing with their own money, because talk is free. Writing a 7-figure personal check is not. CEO Daniel Wagner has not been giving interviews about his confidence in Rezolve AI. He has been buying the stock. Over the last 6 months, he has acquired 812,956 shares on the open market. We are talking an estimated $3.25 million of his own personal capital committed to this stock at current price levels. And just last week, on May 13th, Director Stephen Perry was granted 95,600 shares at a valuation of $2.77. His total holdings now exceed 1 million shares. Most importantly, and this is the detail that matters most, there have been 0 insider sales reported in the current window. 0. The people who know every detail of this company's financials, its pipeline, its client conversations, its burn rate, those people are not selling, they are accumulating. When insiders back up the truck at these prices, you have to at least stop and ask why. And the insiders are not alone. The institutional money flow tells a strikingly similar story. When we look at the current positioning data, we see 100 institutions actively adding to their positions in RZLV compared to 62 that are decreasing. But the names doing the buying are what matter here. BlackRock, the largest asset manager on the planet, added over 2 million shares. UBS added 1.6 million. Nuveen added 1.1 million. Now, you will see that Citadel Advisors made a significant exit, liquidating over 20 million shares late last year. That is a real data point, and we are not going to bury it. But look at what happened immediately after. Tier 1 long-only institutions like BlackRock and UBS stepped in and absorbed that liquidity. The fast money rotated out. The patient, long-horizon money rotated in. Ask yourself, does BlackRock add 2 million shares to a position they think is going to zero? That transition is not random. It reflects a deliberate thesis about where this stock is headed over the next 12 to 24 months. So if the revenue is accelerating, the tech is validated, the insiders are buying, and the institutions are piling in, what are the analysts actually saying? This is where the numbers get almost uncomfortable to look at. We are currently sitting at $2.43. Cantor Fitzgerald has a price target of $8. H.C. Wainwright has a price target of $12. Let me put that in perspective for you. To get from $2.43 to $8, you are looking at a potential 229% return. To get to the $12 target, you are looking at nearly 400%. That is a potential 3x to 5x return just to reach what credentialed institutional analysts consider fair value, not a moonshot, not speculation, fair value. They are pricing in significant multiples because they see Rezolve's agentic AI commerce platform as a genuine contender for the next major frontier in retail technology. And all 7 analysts covering the stock agree, 7 for 7, unanimously bullish. So now the obvious question, if everything we just described is true, why is the stock at $2.43 and why has it been falling? This is the part where we have to be completely honest with you, because this channel does not do hype without context. The 5-day chart shows a 6.5% decline. The stock slipped 2.4% in a single session this week. It is currently sitting below its 50-day moving average. On the surface, that looks bad. But here is what you need to look at more carefully: the volume. The relative volume on this decline is only 0.82 times the average. In trader language, that means this sell-off is happening on low conviction. Nobody is panic dumping this stock. There is no high-volume distribution. What we are seeing looks far more like a technical breather, a temporary absence of buyers rather than a wave of aggressive sellers. And that distinction matters enormously for what comes next. When we look under the hood at the technical indicators, a very specific picture emerges. The relative strength index is sitting at 46.08. That is neutral territory leaning toward oversold, not stretched, not overbought, with plenty of room to move higher without triggering an automatic pullback. The MACD is at negative 0.03, and, this is the important part, it is curling upward, setting up for a potential bullish crossover. That crossover is often the earliest signal that short-term momentum is about to shift direction. And then there is the ADX, the average directional index, sitting at 14.03. A low ADX reading tells us that the current downtrend is losing its structural energy. The bears are running out of fuel. Taken together, these 3 signals form what traders call a convergence setup, not a guarantee, but a statistically meaningful alignment that often precedes a reversal. On the price chart, the immediate obstacle is the 50-day moving average sitting at $2.64. That is the first boss level. If the stock can break above that and hold, the next significant resistance does not appear until the 200-day moving average at $3.46. The gap between 243 and 264 is tight, but it is the exact zone where a short-term trade becomes highly defined in terms of risk and reward. And here is an interesting confirmation signal from the options market. We are seeing concentrated call accumulation at the $2.50 strike. Derivative traders are already positioning for a technical bounce driven by the enhanced partnership news. When options flow aligns with bullish technical indicators, it often creates a self-reinforcing dynamic that pulls the stock price toward those strike levels. For those of you looking at the current setup as a near-term trade, here is the specific architecture. The entry zone is $2.43 to $2.48, essentially buying the dip right at this current psychological support level. The stop loss sits at $2.35, just below the recent floor, to cap your downside if the thesis breaks. The primary target is $2.64, aligning perfectly with that 50-day moving average. And if the stock clears that level with volume, the secondary target becomes $2.77, which, not coincidentally, is the exact price at which Director Stephen Perry received his share grant last week. That price point now carries both technical and fundamental significance. Now, and this is non-negotiable on this channel, we have to talk about the risks with the same energy we used to talk about the opportunity. The balance sheet tells a more complicated story than the revenue chart. In 2025, Rezolve reported a net loss of $101.4 million. The earnings per share is negative 0.38. This is a company that is spending aggressively to grow, and the critical question for long-term investors is whether they can monetize the TCS and enhanced games partnerships fast enough to narrow that loss and move toward a path of profitability. The $360 million guidance is the goal, but guidance is not revenue until it hits the income statement. The short-term trade is about a technical bounce. The long-term investment is a bet on execution, and those are two very different theses that require two very different risk tolerances. Now, before we wrap up, and this is important, nothing you hear on this channel is financial advice. Smart Stocks Sam is an educational and informational channel. We analyze publicly available data, technical setups, and market information to spark your thinking, not to make decisions for you. Always do your own research. Always consult a qualified financial advisor before making any investment decision. Past performance does not guarantee future results, and small-cap stocks like RZLV carry elevated risk, including the possibility of significant loss. Trade and invest only what you can afford to lose entirely. So where does all of this leave us? At its core, Rezolve AI presents a rare and specific type of situation, a high-conviction contrarian setup built on three converging pillars. First, technological milestones. Traceware's near-perfect accuracy is not a marketing claim. It is peer-reviewed, and it provides a real competitive floor that justifies enterprise partnerships. Second, smart money conviction. Insider buying at the $3+ million level, combined with BlackRock and UBS stepping in to absorb institutional selling, is not a coincidence. It is a signal. And third, technical alignment. The MACD crossover setup, the low conviction sell-off, and the options accumulation all point in the same direction. The gap between where this company is fundamentally and where this stock is currently trading is wide, and wide gaps like this do not stay open forever. The question is not whether it closes, the question is whether you are positioned when it does. Whether you are eyeing the short-term bounce toward 264 or you are thinking about the long road to the Analyst's $12 target, this one deserves a spot on your radar right now. Here is my question for you, and I genuinely want to hear your answer in the comments below. Given everything we just covered, the revenue acceleration, the insider buying, the institutional flow, what do you think is the single biggest risk standing between Rezolve AI and that analyst price target? Drop your answer below. I read every single comment, and your perspective might just shape a future video on this channel. If this breakdown gave you value today, please hit the like button. It takes 2 seconds, and it helps this channel reach more investors who are looking for exactly this kind of analysis. And if you are not subscribed yet, what are you waiting for? Hit subscribe and turn on notifications so you never miss a deep dive like this one. And if you really want to support the work we do here at Smart Stocks Sam, YouTube has a super thanks feature. Use it with open hearts. Even a small contribution goes a long way in helping us keep producing independent, data-driven research for this community. Until next time, stay sharp, stay disciplined, and keep investing smartly.